Think of your credit score like a report card for your finances. It's a three-digit number, usually between 300 and 850, that tells lenders how risky it is to loan you money. A higher score means you're a lower risk, while a lower score suggests you might be less likely to repay on time. Lenders use this score to decide whether to approve your loan applications and what interest rates to offer you. Your credit score is calculated based on your credit history, which is a record of your borrowing and repayment habits. By managing your credit wisely, you can build a strong credit history and reap the benefits of a good credit score. Credit scores are calculated using a complex algorithm that considers various factors related to your credit history. Key factors influencing your score typically include payment history. This is the most crucial factor, accounting for a significant portion of your score. It reflects your track record of paying bills on time, including credit cards, loans, utilities, and other financial obligations. Amounts owed. This factor considers how much debt you have compared to your available credit. It's not just about the total amount you owe, but also your credit utilization ratio, which is the percentage of your available credit that you're currently using. Length of credit history. The longer you've been managing credit responsibly, the better it is for your score. Credit mix. Having a diverse mix of credit accounts, such as credit cards, installment loans, and mortgages, can positively impact your score. However, opening too many new accounts in a short period can have a negative impact, especially if you have a limited credit history. Your credit score plays a pivotal role in the loan approval process. Lenders rely heavily on this three-digit number to assess your creditworthiness and determine whether to grant you a loan. A good credit score signals to lenders that you have a history of responsible borrowing and repayment, making you a less risky borrower. When you apply for a loan, lenders typically pull your credit report from one or more credit bureaus. Generally, borrowers with higher credit scores are more likely to get approved for loans and qualify for more favorable terms. On the other hand, borrowers with lower credit scores may face challenges getting approved for loans, and if approved, they may be offered less favorable terms, such as higher interest rates or shorter repayment periods. Interest rates are a crucial factor to consider when taking out a loan, as they significantly impact the overall cost of borrowing. Your credit score plays a substantial role in determining the interest rates you'll be offered by lenders. A higher credit score generally translates to lower interest rates, while a lower score can lead to higher interest rates. Borrowers with good credit scores are perceived as less risky, as they have a proven track record of responsible debt management. Conversely, borrowers with lower credit scores are considered higher risk, as their credit history may indicate a greater likelihood of missed or late payments. To compensate for the increased risk, lenders charge higher interest rates to these borrowers, reflecting the higher probability of default. The difference in interest rates based on credit score can be substantial, potentially costing borrowers thousands of dollars in additional interest payments over the life of a loan. Improving your credit score takes time and effort, but is achievable with consistent effort and responsible financial habits. Here are some actionable steps you can take to improve your credit score. Pay your bills on time. This is the most crucial factor influencing your credit score. Set up reminders or automate payments to ensure you never miss a due date. Reduce your credit card balances. Aim to keep your credit utilization ratio low, ideally below 30%. Avoid opening too many new accounts in a short period. Each time you apply for new credit, it results in a hard inquiry on your credit report, which can temporarily lower your score. Limit your credit applications and space them out to minimize the impact on your credit score. Review your credit report regularly. Check your credit report from all three credit bureaus, Experian, Equifax, and TransUnion, at least once a year to identify any errors or inaccuracies. You can request a free copy of your credit report annually from each bureau through annualcreditreport.com. Disputing and correcting errors can potentially improve your score. To illustrate the tangible impact of credit scores in real-life scenarios, let's consider a few examples. Mortgage approval and interest rates. Imagine two individuals, Sarah and John, both applying for a $300,000 mortgage. Sarah has a credit score of 750, while John has a score of 620. Due to her excellent credit, Sarah qualifies for a lower interest rate of 4%, resulting in a monthly mortgage payment of $1,432. On the other hand, John's lower credit score leads to a higher interest rate of 5.5%, increasing his monthly payment to $1,704. Over the life of the loan, John will pay significantly more in interest compared to Sarah. Auto loan approval and terms. Let's say Emily and David are both looking to finance a new car worth $25,000. Emily, with a credit score of 720, secures a favorable interest rate of 3.5% on her auto loan. David, however, has a credit score of 580, resulting in a higher interest rate of 8%. This difference in interest rates translates to a significant variation in their monthly payments and the total cost of the car over the loan term. Your credit score is a powerful financial tool that can significantly impact your financial well-being. By understanding how credit scores work, the factors that influence them, and the practical steps to improve them, you can take control of your credit future. Building a good credit history takes time, effort, and consistent responsible financial behavior. By implementing the tips outlined in this essay and developing healthy financial habits, you can gradually improve your credit score and unlock a world of financial opportunities. Take charge of your creditworthiness, make informed financial decisions, and pave the way for a brighter financial future.